Welcome back. And in our top business story, a 900 million dirham investment by Nabouda Automobiles was announced this morning, confirming that 10 projects across Dubai and the Northern Emirates are currently underway. Established in 1976, the family-owned company continues to be the largest European vehicle distributor in the Middle East. Over the past 36 years, German brands such as Audi, Porsche and Volkswagen have been at the forefront of choice, according to experts. A positive growth of 25% in sales from June 2011 to the same period this year reflects the region's pole position. The Middle East is home to some of the world's largest facilities, showrooms and after-sales services. Nabouda professionals say that expanding and enhancing their operations network is key. Selling over 7,000 units per year, the CEO of Nabouda Automobiles, Mr. K. Rajram, states that their aim over the next 2 years is to reach 10,000 units annually.
Very big challenge. We sell exclusive brands, ma'am. Amongst our brands, if you give the customer a standard of service which is unrivaled, he will come back to you. And at the end of the day, this recession, like I said, it didn't bother us. We did dip a little bit, but that happened to the whole world. So why is everybody talking about Dubai? The whole world went into recession, but we came out of it quicker. And we are here now, exactly as we were in 2007.
With 96% complete, the Audi terminal located on the Sheikh Zayed Road is the world's largest, valued at 118.5 million dirhams and scheduled to open early September this year. Other projects will span over the next 2 years and will cater to customers in Sharjah as well as Fujairah.
It's not just only about the facility, it's about the people which are in. So we are giving them constantly training. We're trying to not to fluctuate them so much with various motivational ingredients. We have Audi, Volkswagen Middle East as well as Porsche Middle East, which are helping us in order to achieve those targets. So the service excellence within all the three brands is, I think, within the next 2 years coming to a new height.
The GCC's end-of-service benefit system needs to be restructured with increased innovation, according to experts. And the combined liabilities of GCC employers are expected to rise from $16 billion in 2012 to $75 billion by 2020. According to a new leadership roundtable report from research company Insight Discovery, the EOSB system faces numerous challenges, including the safeguarding of employee interests. The report also discussed the evolution of the present system, its possible replacement, and subsequent implications for the financial services industry. Most expatriate employees in the GCC receive a one-off lump sum payment in the form of end-of-service benefit or gratuity, as opposed to the occupational pension schemes of many other countries. Experts say there are numerous issues with the present EOSB system, which needs to be proactively addressed by regulatory bodies and employers.
Research shows, anecdotal evidence shows, that the majority of employers in the UAE and GCC do not proactively fund for their end-of-service benefit obligations. What does that mean? That actually means that the end-of-service benefits are effectively made from cash flow. Well, that's fine if the employer has the cash and business is good and market environment is good, but what if that's not the case, as was the example in 2008, 2009, 2010 with the downturn. Additionally, you will also find that quite often in that scenario, if the employer does not fund to meet the obligation, that when the problem becomes most needed, i.e. in a market downturn, for example, multiple employees are being laid off and all leaving at once, that's the actual time when the employee needs a large amount of cash. And actually that's the worst possible time when they may not have it.
Let's now take a look at the stock indices across the GCC. And in other business news, the currency markets were locked in a tight range for the majority of the week, as participants stayed on the sidelines in anticipation of developments from the EU summit, which wrapped up on Friday. And following a rather well-perceived and positive outcome at the closure of the summit, markets kicked into fifth gear, following the strong sign of solidarity and commitment emerging from the EU summit in Brussels. So we spoke with Gaurav Kashyap, the head of the DGCX desk at Alpari Middle East, for his views for the week ahead.
Well, we view Friday's very bullish move as a temporary rally in risk sentiment. Once again, we did have some very positive developments from the EU summit. Just to highlight, the Spanish banks will receive their recapitalization funds up to 100 billion euros. But the difference between this announcement and the announcement 2 weeks ago is that this 100 billion will not be on the Spanish government's debt books, which means that their debt burden will not increase. The funds directly going to the Spanish banks will definitely improve the risk sentiment in the markets and provide a lot more transparency. But overall, we're not too confident with this risk rally. We expect it to be temporary, and we expect the markets to once again be driven lower this week. We have a packed economic calendar up ahead. We have 3 central banks announcing their rates. The Reserve Bank of Australia to announce their rates on Tuesday, expected to remain unchanged at 3.5%. But then we move to Thursday, where the European Central Bank are expected to cut their rates by 25 basis points from 1% to 0.75%. If we don't see a cut there, then the euro will continue to appreciate against the US dollar. If they do in fact cut it by 0.75%, it was largely expected, but the euro will remain again on the back foot against the US dollar. Looking at the Bank of England, they're expected to keep their rates also unchanged at 0.5% on Thursday, but they might be looking at increasing their asset purchase target from £325 billion to up to £375 billion.